Thank you, John. So I'll start off with Invest Ottawa a little bit. The presentation I'm doing today, you'll see the Invest Ottawa logo in the top corner. It's a presentation that I do, a similar presentation that I do at Invest Ottawa. I've modified it for today's purposes a little bit, but Invest Ottawa is a not-for-profit organization that the City of Ottawa, the Government of Ontario fund, and they provide resources like legal, tax, accounting, marketing, seminars, and they provide those seminars free of charge. It's a great tool that you can use to get that training that's from business people providing training to new people that are entering business. So it's kind of the right people, the right demographic. And they also provide consultations, so you can speak to someone one-on-one about your idea and they can break it down and give you some feedback. And they also provide links to the community, so the loans that John spoke about, the financing and the next step of who you need to meet. So it's a great place to go. I recommend it. I volunteer there, that's my involvement there. My background is I'm a chartered accountant and I work at a company called GGFL, which is in the bottom corner there. So GGFL, they've been around for almost 70 years. They're going to celebrate their anniversary soon, and I've been having a great time there. I've been for 6 years, and my role is to help small businesses with their tax and accounting problems. So whether it's, hey, I need to get my taxes done, or it's, hey, I need a cash flow forecast so I can apply for a loan, or something in between, I come in and help them. So the topic of today's presentation I'm doing is employed versus self-employed, and that's basically to help a person starting a business figure out when they start their business, should they operate as a sole proprietor or self-employed? Those two things are one and the same. Or should they incorporate and operate under the corporate model? So there's a difference between the two, and there's some considerations you want to make before you decide. So when you're starting a business in the health industry, for the purposes of this for this event, you're going to either go into a self-employed opportunity or a partnership. They're similar, or you're going to start off as a company and incorporate and go that route. So here I'm going to try to help you make that decision a little easier. So just a couple things to keep in mind for what I'm talking about today. I'm talking about active business company. So anything in the health industry would qualify. Active business income is treated differently than inactive income in Canada. So inactive income in Canada is things like investments, interest, rental income, things like that. So for today, we're talking about the health and wellness industry. You're actively doing something, you're providing personal training, you're selling a product, that would qualify as active. Canadian controlled private corporation, that means the people that are owning the shares of a business, if you do decide to incorporate, are Canadian citizens. So the next point down, Canadian residents and Canadian resident shareholders. If you decide to involve people that are not Canadians, it changes the way that you get taxed. So for today's purposes, we're just assuming everyone's Canadian that's involved in the company. So there's a consideration when you, so there's an opportunity where you might be an employee of somewhere if you decide to start off in that side of things, like you work for someone else. So there are some big health people in the city, like gyms and things like that. We're going to go straight to the stuff that you're starting a business. So when you start a business, you're going to be inside of that circle. That circle being either you're going to be self-employed, so you're starting your own business and it's in your own name, or you're going to incorporate and operate that business under the corporate logo. So if you decide to incorporate, one of the things you want to keep in mind is the companies on the left side is completely separate from you on the right side. You and the company are not one and the same. The company has its own bank account, its own records, its own legal status, and you as an individual have your own legal status. So some of the things on that slide, like your rental payments, your tuition or your family's tuition, your family members, your investments, those are personal things. So the company and that don't mix. You can't use the company's money to pay for those things straight up. What has to happen first is the company has to give you that money in the form of a salary or dividend, and then you pay the proper tax on it, and then you use that money to pay for your rent and your investments and your tuition. The company can't just pay for it directly. So there has to be a layer in between, and that's salary or dividend to get the money out of the company. If you decide to operate as self-employed, the business and you are one entity. So you and the business are one. That means all the business income and your income, it's all intermingled, tied together.
Sole proprietor.
Sole proprietor, yeah. Sole proprietor and self-employed are the same thing. So if that's the case, in this slide, you see that it's over on the right side. You're one and the same. Then you can use that business income as however you like and apply, pay for rent and things like that out of that income. It's no problem. So there's just a key distinction there of getting money out of a company through salary or dividends. So when you get into the health and wellness industry and you're starting to make some money, now you're going to have to worry about paying tax. So that's a good problem to have because that means you're making money. So hopefully you're selling your product, or you're doing a good job with your gym, or you're doing a good job with whatever you decide to do. So the guy before us, he's selling his forearm and rehab product, or his buddy's selling the tube. So when that happens, and you're in a company structure, you're going to start to pay tax if you're making less than $500,000 of net income at 15.5%. If you make more than $500,000 at 26.25. So for today's purposes, we'll focus on the first number, 15.5. As a small business, you're more likely to be in there, and then maybe after a couple of years, you can hit it big and keep going and going and going. On the personal side, there's different rates in Canada. So if you make less money, you pay less tax, and then you go to the next tax bracket, you pay more tax. And there's a lot of little brackets, like there's a bracket between 11,000 and 23,000 and 23 and 39. There's little brackets. We're just going to jump up to a nice bracket that gives us a big range, which is 46%. So that's when you make between $130,000 and $500,000. So when you're in that range, that's how much you're making. So you might not be there yet, but the goal is obviously you're going to get there, because that's what you want to do. So we're going to be comparing a corporate rate of 15.5 and a personal rate of 46.41. So why doesn't everyone just incorporate right away and start off as a company? The problem is, if you receive the money directly, like you were self-employed, or you receive the money in a company, and then that company pays you the money through a salary or a dividend, it's going to be taxed at roughly the same level. So you're going to end up you're not going to end up better off or worse off if you were incorporated or not incorporated. The money's just going to flow through the company's going to pay its tax, and the company's going to give you the money, and you're going to pay the tax when you take the money out of the company, and that 2 levels of tax equals if you were self-employed just making the money directly. So you're not going to end up any better off incorporating or not incorporating from a strictly tax point of view. So that's what integration is. Receiving directly versus through the corporation should be the same result. So the advantage of incorporation on a tax rate only occurs when you can achieve tax deferral, which is highlighted in that green underline. And that means when you make money in the company, that money is more than what you need to take out for your personal purposes. So now you're running a business that's making $100, and you only need to take out $50 to live on. That other $50, you leave it in the company, and then that $50 gets taxed at the lower rate, the 15.5, versus you taking it out and paying 46.41. So once you can accomplish that, that means your business is successful, and you don't need to take it all out. So you're growing your business, and a point will come where you'll be like, I don't need any more money. I have enough money to live. I make my car payments, I pay my house, I take nice vacations. I don't need any more money. I have enough. And then you can leave the money in the company and achieve tax deferral. But if you're starting up, that might not be right away. Sometimes a person starts up and they're like, I need $50, but my business only makes 20. I'm like roughing it. I'm eating craft dinner. I'm scraping. I'm gotta build it up. So then you might make 40 in the next year, and then you might make 60 in the third year, and now you're making a little bit more than you need, and then it'll go up and up and up, and your needs will change as well. So if you need all the money your business makes, you're not going to save any tax by incorporating. So what I'm trying to say is, if you have a business and it doesn't make more than you need, then you're not going to save any tax. You should not incorporate. You should stay self-employed. But once you start to make more than you need, you definitely want to incorporate and make tax deferral your advantage. So the difference between the rates, 46.41 is the personal rate that we saw a couple slides ago. 15.5 is the corporate rate. So if you leave that money in the company, you don't need it, you save 30.91 of tax. That's the blue tax deferral part. That's huge. That's a lot of money. You leave that money in the company and you reinvest it, grow the business, you do a whole bunch of things with it, and it's really cool if you're able to do that. So there's a numeric example just to prove what I'm talking about. So salary is the same as being self-employed. If you're self-employed earning money, or you have a company that pays you salary and it's your own company, whether you take that money out as a salary or a dividend, you're not any better off, only by a couple dollars at the bottom. So in the first example, there's salary of $100. The company made $100. It paid that $100 to the individual. That individual paid tax of 46.41%. They're left with $53.59 in their pocket. If you use this thing called a dividend, where some people think, well, I'm going to save tax, I'm going to pay a dividend, it's like a buzzword. It doesn't really work out that much better, because you're going to have money in the company of $100, there's corporate tax you have to pay, and the dividends are basically after-tax profits, after the company has paid tax that you take out. So that's getting a little bit on the accounting side. And at the end of it, when you add up all the rates, you're going to have $56.98 in your pocket. A little bit more, $3.39, but that's not a lot more. So on $100, $3 is not a lot. So it's just a little bit. So it's not necessarily worth incorporating just to save money because people are like, I'm going to pay a dividend. That's not necessarily the best part. So advantages and disadvantages. The first one is tax deferral. If you incorporate, you get to use tax deferral. It's huge, it's awesome. You can save some money. Not everyone can use it right away because if your business is not making more than you need, then there's no tax deferral. The second one is income splitting. So when you have a business, you can involve other people in your business. So let's say you have a spouse, let's say you have some kids, let's say you have some parents, you have some siblings and you want to give them some money, you can give them some money when you incorporate. So what you would do is you would set them up as shareholders of your business so they would be able to take a dividend out and you could pay them. And instead of you taking all that money, in Canada the more money you make, the higher your tax bracket goes. But if you have some people in your family that don't work or work at lower paying jobs, you can give them some money and then they'll have tax savings across if you sprinkle it. We call it sprinkling. And the next one is liability and creditor proofing. So in a corporation setup, you have a business and it has its own legal entity, and that legal entity allows you to shelter yourself from possible people coming after you. The company has its own standalone assets, standalone entity, so if people come after you and it's a company, they can only get what's in the company. You're separate. But if you're self-employed, you and the business are one thing, so if something goes seriously wrong, your personal assets are at risk. And there's more legal stuff to it than that, but I'll just leave it at that, and a lawyer will go further into it. The lifetime capital gains exemption, so if you build this business up over time, and it might take you a couple of years, it might take you your whole life, you can get up to $750,000 if you sell that business. If someone's willing to pay you $750,000 or more, you can get that money tax-free, and that's huge. So you can get this huge tax-free check. That, if you sell it for more than that, the first $750,000 is tax-free, the stuff after that's taxed. You can simplify raising capital. So let's say you have a business and you want to get some other people to invest because you need some startup funding. It's easy to do it under a corporate umbrella because you can be like, hey, you give me $100,000, I'll give you 10%. It's almost like Dragon's Den. You can make people an offer like that. When you're a sole proprietor, you're self-employed, it's harder for people to do that. So people can be like, I'll give you money, what do I get back? Well, you're like, I'm just self-employed. It'll be a little more tricky. When you have a company, you can very easily say, hey, give me $50,000, I'll give you 10%, or whatever the negotiation is. And then perpetual existence. So that just means when you have a business, the business will continue on forever, even if you're not there anymore. You can sell it to someone else and they can continue it for you. You can transfer the business to your spouse, your kids, and they can continue it for you. There's a couple of disadvantages, so it's not necessarily all gravy. The disadvantages are setup costs. So to set up a company in Canada, there's costs associated with it. You're going to have to go on the Government of Canada website, you have to pay a fee. If you want to get some advice from an accountant or a lawyer to do it properly, there's going to be a fee to pay the accountant and lawyer. There's required filing, so when you have a company, T2 refers to corporate tax return, you have to file that. T4, T5, those are some slips you have to file, HST returns. So there's going to be some extra stuff you have to do as a company that are going to take time if you do it yourself, or they're going to cost you money. So it might not, if you don't have enough advantages, it might not be worth incorporating. Losses trapped within the company. So if you lose money and you have a company, that company has losses carried forward until the company makes money, and then that future income is applied against those prior losses and they offset. So if you have a loss in year 1, in year 2, in year 3, and then in year 4 you make money, you can apply that loss against that income. So if you get to year 4, that's great, because now you're applying those losses to your income that you have in year 4. The problem with a lot of small businesses is when they start, they might not get to year 4. A lot of businesses don't get to that level. Sometimes they fold, they close up. So if you have a company, your losses are stuck within the company until you make money to use those losses. On the other hand, if you're self-employed, if your business loses money, you can take that loss in the company and apply it to your other forms of income. If you happen to have a job on the side, you can apply it there. If you have investments, you can carry it forward to future years on your personal side. So there's a better usage of loss if you're doing it under the self-employed umbrella. And then strict use of shareholder funds. So when you have a company, you cannot just take the money out to do whatever you want with. The money has to stay in the company, and you have to take it out as a dividend or salary. And there has to be a lot of record keeping to show what is it. So for some people that don't have good record keeping, it can turn into a mess. So there's a little bit of extra record keeping involved. Now if you incorporate and you think that's for you, so we've passed the self-employed versus incorporate option, and you're going the incorporation option, you're going to say, how do I pay myself, salary or dividend? The answer is it depends. So we already talked about the tax rate benefit. under the tax rate benefit, it's very close. The dividends are better by 3%. So if you decide to go strictly on tax, you're going to pay dividend. But there's a couple other considerations. So this is the dividend example again, 43 versus 46, 3% of savings. There's a couple other characteristics you want to consider. So if you pay yourself a salary, you're going to create some things for you that a dividend will not. So for instance, if you have childcare costs, you need to have a salary to deduct your childcare costs. If you don't have a salary, you cannot deduct childcare costs. That's something for people with kids that put them in, with a nanny or put them into some school programs. RRSPs, if you want to contribute to your RRSPs and you think that's important to you, you need to have a salary in order to pay yourself to create the RRSP contribution room, so that's important. CPP eligible, so when you have a salary, there's this thing called CPP deduction off of your salary. It's like money that goes into the government's hands and the government does something with it, and down the road when you retire, you'll get CPP back. For some people that's a great idea, for other people they're like, well, I don't know what the government's doing, or I don't care, I don't really think that's important to me, I don't want CPP, I don't want to worry about the deduction. With the dividend, you don't have to worry about the CPP deduction. For salary, if you pay your family members, they have to be reasonable. You can't just pay your family members whatever you want, they have to be reasonable. And there's withholdings at source. That means on your salary, you have to take taxes withheld, CPP, EI off of that salary, then pay yourself the gross amount. Because when you're a business owner, you can choose. I want to pay myself a salary or a dividend or a combination of both. You can do a mix, you can do both, one or the other. It depends. So those are the salary considerations. For dividend, you can do income splitting. So if you give shares to your other family members, like we talked about, your brothers, your kids, your parents, you can give them some dividends. And if they're over 18, that's perfectly legit. There's no problem with that. And then you're utilizing their lower tax brackets if they don't have any other income. So if they're not making any other income, they can get up to $40,000 tax-free. So you can split it up if you have a couple kids or some brothers and sisters, and that's great. There's a transfer of cash. So when you pay someone a dividend, even if you want that money back, you still have to give them the actual cash, and then they have to give it back to you, even if you're a family. And there's no reasonableness test. So on the salary side, if you pay someone salary, they have to do something to deserve it, earn it. If you pay someone a dividend, it doesn't really matter. If they're an owner of the company, they can get a dividend. And then there's installments. So then the CRA will ask you to give them some money periodically over the year to take care of your tax situation you'll have at year end. So those are most of the considerations. Just to recap really quickly. So when you have a business, so the first one doesn't really apply here. Are you an employee? You're going to start your own business. That's mainly for my other presentation. When you're going to start your own business, you're self-employed or incorporating, you're going to ask yourself, what stage of the business are you in? So is the business making money more than you need? Tax deferral. Let's incorporate. Are you in a stage of your business where you're incurring losses? Then it might not be a good idea to incorporate. Stay self-employed, use those losses personally if you can. If your personal tax situation is you have no other forms of income, or you have other forms of income, it'll affect your decision a little bit. And the last one, do you want to include others in the sharing of your business, the income in your business? So some people say, yeah, I have kids, I have spouses, I'm going to pay them, I'm going to income split, that's great. Other people, they're not as, either they don't have anyone to share with, they're just a single person with no family, or they don't want to share with anyone. Everyone's got their own reasons. They're like, well, I don't want to give any money to my spouse or my well, maybe the spouse is kind of extreme, but maybe my brother or my parents, I don't want to give them any money. So it's, it's their choice, right? It's their business. So if that applies, then you might not want to share. So in a nutshell, that's more or less it.
But you were saying you're able to transfer, like, the cash if you were to.
Yeah. So if you do pay someone a dividend, you have to transfer the cash to them. You can't just say I'm giving them a dividend, but I'm keeping the money. So they put it on their tax return. You have to give them the cash. So you have to have a good relationship with them because you're giving them money. So either your understanding is, if you're related to me, I'm going to give you money for my business, but I expect you to give it back to me. I just want to use your tax rates. Or I'm giving you money, but I'm giving you money specifically, like parents say to kids, so you use it for school. You're not just blowing it on a car, on something I don't want you to spend on. It has to be defined and agreed to beforehand. And then once the money goes into the kid's bank account, they can, in theory, if they don't want to listen to them, they can rebel and not do that. So that's why there's a little bit of sometimes apprehension on the part of the people giving the money out. So if you do pay them a dividend, you have to give them the cash. And then if you have a good relationship with them and trust them, that's great. If you don't, you might have to think twice before you give them the dividend.
I have a question.
Yes, of
course. All right,
so
now you were talking about corporation and dividends. Now, you can incorporate a profit and you can incorporate a non-profit. Can non-profits have access to dividends as well, or
No, so nonprofits don't have the traditional shareholders and the traditional after-tax profit, because in theory a nonprofit is going to break even by its name, not for profit.
Yeah.
It's looking to break even, so there's no after-tax profits to distribute. And on the other hand, a not-for-profit doesn't pay any tax. So the not-for-profit has a lot of different pros and cons associated with it. So if you have a not-for-profit, the dividend and that stuff doesn't apply, but you can pay yourself a salary out of a not-for-profit, no problem.
Cool.
You have any other questions, Adeem?
No.
Cool. Thank you.
No, thank you, Sarwar. We really appreciate all you've done, all the time and effort that you put into the slides, coming here and all that stuff.
My pleasure.
We have a present for
I
you.
appreciate it, very
On
kind.
the behalf of SGS Fitness and everyone in attendance, I want to thank you for your time and cooperation. And
Thank you, John.
It's a token of our appreciation. Thank you very much for coming to present, and hopefully you'll come present for us at our next event.
I look forward to it.
Thank you very much, sir.
No problem.
You have
Thank
a great day.
You too.
Yay, Sarwar. All right. And last but not least is Victoria Barney, who has not shown up yet, but I knew she was going to be coming here because your class finishes at 8.